Welcome to the Homebuyers Hub, brought to you by Remax Executive Realty. We are focused on cultivating confident consumers in our community. Thank you so much for taking the time to sit in on this webinar today. My name is Anika V. Brown, your neighborhood realtor. I am very passionate about providing information that will transform the lives of others. Some history about our company, Remax Executive Realty. We have been in existence for 16 years. Our broker owner, Joseph Trella, has been in real estate for over 20 years. As a company, we have been able to assist multiple families and individuals with their real estate needs, making them happy customers and clients. This special community, the Home Buyers Hub, is our effort to reach those with a desire to purchase but lack the essential information that is needed to make an informed decision when making the largest purchase of their lives. So, looking at our overview, for the next 30 minutes or so, I will be sharing with you three very powerful things you need to know before buying a home or any real estate. So, the first thing that we'll be looking at is understanding your debt to income ratio. Then, we'll hop into understanding how credit score works in the buying process. And then we will look at understanding costs involved in the buying process. My mission today is to help you get over the fear of buying. One key thing to understand is that most individuals are usually fearful because there is not enough information to predict an outcome of a situation, or there's not enough information for the person to navigate through each step of any situation or of any process. If you really think about it, it's like traveling to any destination for the first time or even the second time. You would be fearful or a little nervous about the trip, contemplating what would happen if you made the wrong turn, analyzing how long it will take for you to get there, worried about the types of road that you may have to drive on to get to the destination. But when you have a GPS or some sort of navigation system, it will already have all the information needed and also provide you with alternate routes that you can take to get to the same destination. So, again, my goal today is to make sure that you have this pertinent information, which is sort of like your GPS or your navigation system that will make you a confident buyer. So, the first thing that we're going to look at is your debt to income ratio. Why do you need to know about this debt to income ratio? I must tell you that all mortgage companies need to know that you will be able to make the monthly payments on the loan that they will provide you with to purchase your home. So, it is important that they analyze your ability to cover this expense in addition to what you already have. Your debt to income ratio will also help to determine how big of a loan you will qualify for, meaning how much you, as the consumer, can afford. Higher ratio. So, after an extensive study by mortgage companies, they have found that individuals with a higher debt to income ratio are more likely to have a hard time keeping up with their monthly mortgage payments. So, to predict the likely outcome, mortgage companies use this tool to help them make their decision. Now, this measuring tool, the debt to income ratio that they use, has two sectors, a front end and a back end. The front end ratio is used to assess your anticipated monthly housing debt divided by your gross income. And this will reveal your potential housing costs should the loan be approved. So your principal, your interest, your tax, and your insurance is calculated here. The back end ratio assess all minimum monthly bills plus the expected principal, interest, taxes, and insurance should the loan be approved. So, how much of your income would be used for your mortgage payment and other debts if the loan is approved? Now, this ratio is calculated by using your total monthly revolving debts divided by your monthly gross income. Then you multiply that by multiply the answer that you get by 100. This will give you your debt to income ratio, and this is recorded in percentage. The highest point uh, debt to income ratio accepted, it can vary. So, depending on the lender and the type of mortgage that you're applying for or that you qualify for, that's how the percentage will vary. So a lender may work with you or work with an individual applying for, say, an FHA loan with a ratio of 46.5%, while another lender may only accept 45.5% for a conventional loan. So when talking about debt as it pertains to your mortgage, not all debts are taken into consideration. So let's bring some relief to those of you who are thinking, oh my goodness, I have just this basket of debt that I have to take care of that you currently have that seems insurmountable. So, what debts are included in the back end ratio? Remember that the back end ratio is used to assess to assess how much of your income would be used for your mortgage payments and other debts if the loan is approved. So, your mortgage payment, if approved, insurance, taxes, uh, homeowners association fee, if that applies. So, that doesn't all apply. It applies to condominiums, it applies to some townhomes. There will be a homeowners association fee with some townhomes. So these are included in your back end ratio calculation. Debts that are not included are non debt payments. So things that you did not borrow a loan to get, or things that if you don't pay them, then you won't have access to them. So sometimes I'll have individuals say, I've been paying my phone bill on time, and or they'll say, I'm never late on my electric bill. That does not count when it comes to getting a mortgage. So your utilities, like your water, your sewer, your trash, that does not count when it comes to working out your debt as it pertains to mortgage. Your cell phone, your internet, your cable, they do not count. So because these services, if you don't pay them, they'll be disconnected. So they do not count. So if you're thinking about all these debts that you have with your cell phone and with your utilities, you can be at ease right now because they do not count. All right, let's keep moving along. So, key points. The key thing that I want you to pull from this portion of the webinar is to keep your debt as low as possible so you can qualify for the most amount allowed for your income bracket. Also, never fear talking to a lender who can provide you with real time numbers and tell you what is or what will affect your chances of getting the most money allowed. And if you currently have a substantial amount of debt, it is crucial that you use a pay down plan to reduce your debt as soon as possible. So, moving right along, let's talk about credit score. We are going to talk about credit score. I have come to realize that many individuals do not understand how credit scores work. So, I'm going to give you a really quick crash course in credit score. Take notes, all right? So, a credit score is a numerical expression based on a level analysis of a person's credit files to represent the credit worthiness of that individual. A credit score is primarily based on a credit report. This information typically sourced from credit bureaus. Lenders, such as banks and credit card companies, use credit scores to evaluate the potential risk posed by lending money to consumers, and it also helps to mitigate losses due to bad debt. Lenders use credit scores to determine who qualifies for a loan and what interest rate they will be charged and what credit limits they will be allowed. Lenders also use credit scores to determine which customers are likely to bring in the most revenue. Credit score is not limited to banks. It's not. Other organizations, such as a mobile phone company, insurance companies, and landlords, yes, landlords, and government departments employ the same techniques. Digital finance companies, such as online lenders, also use alternative data sources to calculate the credit worthiness of a borrower. What I really want you to hear is this part that lenders use alternative data sources to calculate the credit worthiness of a borrower. This is why there is a big variation between what you see on platforms such as Credit Karma versus what the lender tell you their after their assessment. So again, you will see a huge variation between what you see on platforms such as Credit Karma versus what the lender tell you after they have done their assessment. So banks and mortgage companies, they pull their information from different sources to see your credit worthiness when it comes to a mortgage. The complete pie for credit score has multiple sections that you need to know and monitor closely. So 35% of the pie is your payment history. Do you pay on time? How many accounts are past the 30 days mark, the 30 days overdue mark? 30% is how much do you owe on loans and credit cards? Are you drowning in your current debts? 15% is length of your credit history. Yes, history is important. How long have you had that credit card? How long have you been paying on that car? And then 10% is the types of account that you have. Is it credit cards, student loans? You'll hear someone or you'll hear people talk about healthy loans and unhealthy loans. So this area looks at that. Is your credit type? Is it a mortgage? Is it medical bills? And then the 10%, the last 10% is recent credit activity. Has there been a new line of credit open? Has there been recent hard inquiries added to your file, whether for a car or a home or a personal loan? Now that makes up 100% of your score. So that's your payment history, loans and credit cards, length of credit history, types of account, recent credit activities. That makes up 100% of your credit score. So here are your key points for this section. I want you to keep them in mind when it comes to your score and getting approved for a mortgage. So, monitoring services such as Credit Karma is not usually correct. And I'm sure by now some of you may have experienced the vast difference that there is in platforms like Credit Karma and when you actually go to a financial institution. So again, monitoring services such as Credit Karma is not usually correct. So you cannot use that to determine if you are ready to purchase a home. If you did not pay for the report you are using to guide your decision, more than likely the information is not reliable. Lenders use different algorithms to calculate your credit worthiness. Yes, they do. Now, there are multiple reporting agencies or bureaus, and the lender will usually go with the middle number that they get from these bureaus. So think of it like this: if you have Equifax showing 620, TransUnion showing 650, Experience showing 670. The lender will most likely go with the 650, which is the middle number. Why is it important to know this? Your credit score is going to be one of the main factors that determines how much you qualify for, what type of loan you qualify for, and what your interest rate will be. So even though interest rate may be lower at a 670, 650 is sort of a safe zone for the lender, and that is what they will go with. Your credit score also helps with how high the lender is able to push your debt to income ratio. Remember, we talked about that earlier, that percentage. So, depending on your credit score, it gives the lender sort of a wiggle room to how far they can push your debt to income ratio. Now, I won't go too much deeper into this portion because it will take too much time. But when it comes to getting qualified for a mortgage, you want to have a good credit score. If you are here today and your score is not at the level that you want it to be, there is still hope. There is still hope for you. So, credit management, and this is where the hope comes into place. Buying a home takes planning, and this portion, which is credit management plan, it has to be a part of that plan. It has to be. So, with the right plan and tools, you can get to the level where lenders will pretty much be chasing you down to give you a mortgage. Your plan should include paying your bills on time to avoid negative impact on your payment history, keeping your total debt amount as low as possible. Do not wipe away all your credit history, as the length of time matters. It's important. Remember, we looked at that on the credit pie. So the length of time matters. Avoid opening new lines of credit close to the time that you will apply for a mortgage. Please keep these important points in mind for credit management. So, moving right along, let's look at some costs that are involved in the buying process. This topic is usually the one that is on the forefront of every buyer's mind. I always get the question, how much money do I need to have on hand to purchase a home? I always get that question. And the truth is, there is no exact number that any agent can give you, and you will see why as we move along. So, the amount of money needed will depend on many factors. One being the type of loan you apply for or the type of loan you qualify for. Now, the three major loan types that you may have heard are conventional mortgages, FHA mortgages, and VA mortgages. I'm going to save time by not going too deep into each of them, but only review the costs attached to them. All right, let's do that. So, types of mortgages, conventional, FHA, VA. This is just the main ones that you will hear more often about. So, with a conventional loan, you can put down as low as 3%. So, if your expected mortgage or the home that you're looking at costs 200,000, your down payment would be 6,000. So, this down payment does not include closing costs. That's just your down payment would be 6,000, the 3% of the 200,000. Now, quite often buyers will go for 20% down. Why is it beneficial to put 20% down? This means no mortgage insurance, which is usually one part of your total mortgage payment monthly. This is because of the assumption that if you can put 20% down, you're likely you're not going to default on your payment. So, pre qualification for conventional loans is a bit more stringent in terms of income and asset than a FHA or a VA, which is expected because conventional loan is more desirable in any transaction than FHA or a VA loan. Conventional is usually the first choice for the seller side, also because the stipulation when it comes to appraisal are not as strict as a FHA or a VA loan. Now, for FHA loans, FHA just means Federal Housing Administration. This is basically a grant from the government. That's what it is. You can put down as low as 3.5%. This type of loan is for buyers that does not make a lot of money nor have a lot of reserve in the bank. If you were thinking to ask this question, because I've had someone ask before if you can get multiple FHA loans. Yes, you can get an FHA loan multiple times, but here's the thing to it, you can only have one active at a time. This is to prevent buyers from using this loan to purchase investment properties. Now, the next type of mortgage is a VA loan. This loan type is guaranteed by the United States Department of Veterans Affairs. Some great things about this loan type is that it never carries a mortgage insurance. So your monthly payment would be less than other loan types where less than 20% is not put down. So with VA loans, underwriting guidelines are more flexible. Another great thing is that it allows 100% financing. So that means even if you don't have the down payment or if you don't have money for the down payment, you can still get a mortgage. It can be financed 100%. Based on the name of this type of loan, you should know that the first qualification is that you must be a veteran or a current service member or married or a qualified family member to take advantage of this loan type. So, some additional costs. We are coming close to the end. So, some additional costs that's involved in buying a home. Some fees that are listed here will be calculated as a percentage of the purchase price of your home. So, this is why I said that there are many factors that are involved in coming up with the amount that you will need. And there is no exact number to give you up front until you have found the home that you like. You've been approved for a certain loan type. So these are the things to keep in mind. Some of the fees will be calculated as a percentage of the purchase price of the home. All right, so let's go through the list. You have title insurance, that you need to pay. uh, Mortgage origination fee. Usually there's a flat rate for that, ranging between $900 and $1,000. You have appraisal fee. You also have a fee for recording your deed. You also have prepaid homeowners insurance and taxes for 1 quarter at closing. You're going to pay that as well. You're going to pay a home inspection. That could include termite inspection as well. Radon, if you want to do that. Radon testing is optional. When I purchased my home, I didn't do one, but there was another home that I was looking into. And based on the location where it was at, it was suggested that I did a radon test, and I had that done. You can also choose to do a structural inspection. That would be an additional cost, but that's optional. Also, attorney fees if you choose to use one. Here in South Jersey, you don't have to use an attorney, it is optional. So, those are the main costs that are involved in the buying process. I do believe that knowing this information, going into the home buying journey, will make you more confident than someone who takes on the journey just knowing that they want a home and not understanding what comes with it. Having this information will also prevent any frustration while you are going through the different checkpoints that are involved in the entire process. So, a really quick recap. We're almost at the 30 minutes mark. A really quick recap. Today, we covered understanding your debt to income ratio. Your takeaway is to keep your debt low to increase your buying power. We looked at understanding your credit score and how that impacts your interest rate and the loan type that you would qualify for. We also covered cost involved in the buying process. Your total out of pocket is really going to depend on many factors that are included in the process. The type of loan you qualify for and the home that you choose to purchase is also a factor in how much you're going to pay out of pocket. Alrighty. So I want to take this time on behalf of the team at Remax Executive Realty and myself. I want to thank you for taking the time out of your busy schedule to sit in on this webinar and to get this information. I hope that this has brought some ease to your plans to purchase a home. If you have any additional questions, you can find me at 199 West Hampton Street, Pemberton, New Jersey, or on my cell phone, 347-230-2772. I want you to enjoy the rest of your day. Send me an email if you think of any questions that you need answered. Anika V. Brown at gmail.com. Again, thank you so much for joining me here on the Homebuyers Hub. Now, until next time, I want you to enjoy the rest of your day. Bye for now.